What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of chip manufacturer Broadcom, see if shares are trading at a good entry point for long-term investors. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on May 4th, 2026. So let's dive right in here for the past 12-month price charts for Broadcom. You can see that within that time frame, investors received a 111.1% return, a phenomenal return. Compare that to the benchmark, which provided a 28.9% return over that same time frame. That does have a relative outperformance of Broadcom shares relative to the benchmark of 82.2%. You can see also that shares on a year-to-date and 1 month basis have significantly outperformed the benchmark. That's also because of the rally in markets as a whole, but specifically in the chip sector in the month of April and continuing into the month of May as well. In that top chart there, you can see that shares are trading at or near their 52-week high. We also see that shares are actually trading above both 50 and 200-day moving averages, and there is now a technical buy signal when we see that 50-day moving average in the green line actually surpassing the 200-day moving average, that is the orange line. So a good technical buy signal for investors currently. There are 46 analysts that have an average price target, give or take, of 12.5% upside from where shares traded on market close of May 4th, 2026. I'll touch on that in the next snippet, but what's really interesting here is that exceptional EPS growth from 25 through 26, almost doubling, and having almost 50% EPS growth from 26 through 27. That is remarkable and really is a testament to the backlog and also the demand for the custom chips that Broadcom produces. You can see there a very modest 60 basis points, a 0.6% dividend yield that is transpiring to a $2.60 dividend per share. Not bad, but they do have a significant track record of increasing the dividends over the past decade and also aggressively buying back shares, which acts as an artificial dividend for long-term shareholders. When we look at the fundamentals of the company, you can see there is sales growth over the past year of 25.2%, phenomenal growth, and we see those trending in the right direction. We'll see in later snippets. But even when we look at the profitability here, gross margins of 65%, quite remarkable there. You can see the net margins that also go to 36.6%. Both gross and net margins are outpacing the industry and the benchmark rates handsomely. And a good metric I want to take a look at there is the return on equity. You can see that at a 33.4% return, which really does indicate that management is allocating capital effectively. And for Broadcom's business, that inevitably is research and development to stay ahead of the game. And that has paid dividends with the custom chips that Broadcom produces. So fundamentally, the company is still looking good. And when we look at actual valuation metrics for shares, depending on how or what you look at in terms of a valuation metric, Broadcom shares can actually be looking either quite expensive or actually quite cheap. And the contrast there is the trailing PE, which is currently at an 81.2 versus the forward PE at 28.3. We really do care about the forward PE when we're investing, especially long term for any company. But when we're looking at solid fundamentals and having a forward PE of 28.3, that does indicate actually a fairly decent value to get in. Price of sales at almost 30 is concerning as well, but I'll touch on this in a later snippet of why that isn't really too much of a concern. But right here is those 46 analysts that have a exact 12.34% upside from where shares actually traded on May 4th, 2026. The biggest bull here has an almost 50% upside. And I want to mention the most pessimistic analyst has a 14.55% decline from where shares traded. I want to mention that in the trough of the March sell-off, shares actually traded below $300 per share. And you can see in that top graph there, that is the dotted line, which is the analyst average price targets, and the blue line, which is the share price. Shares were actually declining from really December of 2025 until the end of March of 2026. In that time frame, Analyst price targets were not revised down, which is a healthy sign. As you can see here, when we just want to look at the forward PE, in this case, that's currently at a 28.3, 5-year average of 22.6. It is fairly in line with both 5 and 10-year PE averages for Broadcom. So not really anything concerning in valuations. And I want to mention that when you look at the start of 2025, forward PEs of 41.9, but more importantly, trailing PE of 219.3 was very high valued, but shares continued to rally because fundamentally the business was still growing and shares grew into their valuation. And let's see if that will continue for Broadcom through 26 and 27. This is just a peer analysis here. You guys can take a look at that. But what's quite telling here is just take a look at Intel on the far right. No trailing PE, the forward PE of almost 81 for a company that since 2000 to realistically end of March of 2026 produced almost $2 per share return in 27 years investing is laughable at that. So I just want to point your attention to that there on Intel. And when you look at these valuations on the PEG ratio, especially for a growth company, Broadcom is one of the cheapest value names. Intel is cheaper, but fundamentally is not as strong as Broadcom, nor in its product offering as well. When we look at profitability ratios, everything is trending in the right direction. That return on assets, equity, total capital, and invested capital is also healthy. And most of that is the research and development that produces the custom chips that essentially dominate right now in the space for Broadcom. And when we look at the financial statement analysis, this is what we like to call a sleep well at night business. Just look at these CAGRs here on 5 and 10-year basis. You look at sales and revenue of 21.7 on a 5-year CAGR, 25.1 on a 10-year CAGR. Phenomenal operating income there, 43.1%. 5-year compounded annual growth rate, pre-tax income, net income, and really look at that earnings per share, almost 50% on a 5-year compounded annual growth basis, and a 25% 10-year CAGR. Phenomenal company, and these trends are what we want to see. Fundamentally, business is looking good. Projections are also looking phenomenal for Broadcom as well. And I just want to include this snippet here. This is actually from October of 2025. So a little bit of the revenue that is comprised here is outdated, but the trends actually remained intact over the past few quarterly reports. A quarter of the revenue still does come from the US. What we don't want to see is that mainland China and Singapore declines, and you can see significant declines on that 3-year trend line for mainland China. I do believe that has continued in the most recent quarters and may continue, especially with the geopolitical tensions between the US and mainland China. But on the flip side, it's very positive to see India, Japan, South Korea, Australia, and Indonesia, especially India, they're the most populous country that is heavily investing in its technological development and advancements in both its private and public sector. In order to do so, you need those custom silicone chips that Broadcom produces, and we'll touch on that on the last snippet in the next slide here. But seeing that India trend of 40% change year over year, phenomenal, and Japan as well. This is what we want to see, diversifying their revenue base, and essentially, I do believe that mainland China revenue will continue to trend down with geopolitical issues, but also with China pretty much making their own chips in-house or in-country, I should say. So we should continue to see that decline over the long term. Now, I do want to touch on a few good and bad points for Broadcom, but I do just want to mention that these points are relatable to its competitors as well, more specifically talking about Nvidia, AMD, Qualcomm, and Intel in this case as well. But I'll first start with the hypergrowth in AI silicone. Broadcom's AI-related revenue is accelerating and should continue to accelerate. For Q2 of 2026, the company guided for $10.7 billion in AI chip revenue alone. That's a nearly 28% jump from the previous quarter. Not previous year, previous quarter. That is phenomenal. Management has actually even teased a quote-unquote line of sight for $100 billion in AI revenue by 2027. That is a huge milestone. And if they're able to achieve that and overcome that $100 billion mark, that will provide a nice bottom line to revenues and in turn, hopefully, better returns for shareholders longer term. And I've been talking about the custom chip dominance of Broadcom. Unlike its competitors who are focused on general GPUs, Broadcom actually excels in custom application specific integrated circuits. They partner with hyperscalers, more specifically in Broadcom's case, Alphabet, which is Google, and Meta, to build tailored AI hardware, which creates a sticky ecosystem that is difficult for Broadcom competitors to displace. That is what we want to see. And creating that stickiness opens up other avenues of revenue. In this case, we'll talk about the VMware synergies for Broadcom. And we've been able to see that the integration of VMware is actually contributing more stable, recurring, high margin software revenue. This provides a cushion of predictable cash flow, which does help fund the massive research and development that is required to stay ahead in the semiconductor race. This is what we want to see. We looked at in other videos the software segments of companies, and that historically is a very high margin business. And if Broadcom is able to leverage that stickiness that it provides with its custom proprietary chips and have that high margin service revenue and software revenue, this will contribute better returns fundamentally for the company. And we did see that 0.6% dividend, which is very modest, I will be honest. But with the amount of cash that Broadcom has continued to accumulate over the past few years, they have increased their dividends significantly and have been aggressive in buying back shares. But I do believe in a lot of these chip companies are going to be doing longer term. And you can see this in the past with oil and gas companies when they've had significant cash flows and really become cash cows. They did issue special dividends. I do believe that's in the table in the years to come. I don't believe that's immediate right now for a lot of the cash flow juggernaut names in the chip space. I'm talking here Nvidia, Broadcom, AMD, and I do believe Micron as well. When we look at a few things here, like I mentioned before, when you look at that forward PE of 28 and the trailing PE of 80, depending on the valuation metric that you use, it will skew towards either an overvaluation or undervaluation of the name. But we do care about long term. We do care about forward looking. So the forward PE and the PEG ratios are not overvalued for Broadcom whatsoever. I know valuation was a concern previously, but I do believe that is subjective in a case. The heavy customer concentration is a problem that I have seen come up, but it's really not an Broadcom specific issue. It is a sector issue. You do see the hyperscalers, the big seven, really making up a bulk 70 to 90% in some cases of the revenue of these companies. And that is a problem if the companies ever do scale back. But we just recently saw at the end of April and beginning of May, a lot of these technology companies actually reporting and increasing their capex. Like I mentioned, there you have Meta that we saw increase revenue. Sorry, my apologies. Capex from 135 billion on the top end range to 145 billion. These companies are not scaling back their capex, but having your such a high concentration in handful of companies that are generating your revenue is a worry, I will say, but I don't see that being a problem until at least 2028, 2029, when this big capex spend from these hyperscalers is projected to be scaled back. But again, if there is technological developments, the capex spend retracements, I don't believe will actually come true. And a problem with the chip sector as a whole, it is a very cyclical sector. And if there are macroeconomic slowdowns, we are having the conflict increase input prices. This will cause a drag both on margins and bottom line for Broadcom. Historically, when we see macroeconomic issues for all these chip manufacturing companies, you do see their customers scale back spending, which does in turn lead to lower revenues. But again, once we look at those most recent reports from these technology companies, don't really see that being a big issue right now, at least for the next 12 to 24 months. As always, guys, take this information as you will. I just wanted to present to you guys the facts that I was able to find and the information I was able to gather here. Please do hit that like and subscribe button and stay tuned for the next video.